The next area of our presentation that I wanted to speak with, kind of taking off of what Shawn's just talked about, is going to be address some red flags in business valuations. So part of this might be if it's a dispute and you have a valuation from the other side and you're wanting to decide, hey, do we accept this valuation? Do we want to get our own valuation and kind of have dueling valuations as often is the case in a litigation context or what have you? I think one thing to keep in mind overarching is that business valuation appraisers are relying on the business's financial information that has been provided to them. They accept that as accurate, and they don't make any assurance as to the accuracy of the financial information that they're relying on to complete the business valuation. When you look at the business valuation report, there is that disclosure in the body of the report. It's there every time. So what does that mean? That means that you want to make sure that you're comfortable with whatever financial information the business appraiser was relying on is reasonably accurate. And there's a few ways to determine that. One is just by having a good understanding of the company and the company's operations and feeling that those are reasonable numbers. If you don't have that insight, are the numbers from audited financial statements? Has audits been performed and things of that nature that give you some sort of reasonable assurance about the underlying information. Now, for smaller businesses that are often involved in these business divorce cases, there usually aren't audits necessarily that have been performed. Usually the underlying financial information that the appraiser's relying on is provided from the company, often their internal accountants or someone who may or may not be overly qualified to present, detailed, reliable accounting information. So you want to keep that in mind. So what are then some red flags that you might see in business valuations that might want you to either work with the appraiser to revise the valuation or get your own valuation? And so the first item here is measuring the business value against reported accounting or tax profits instead of cash flow. As Shawn talked about earlier today, it's all about cash flow, and it's determining what is the appropriate cash flow from the business after you take out of the excess of things that the controlling owner or the manager might be drawing from the company that is, should be reflected appropriately in the cash flow, and may or may not be. Omitting key assets and liabilities. Obviously, if you're wanting to increase a valuation, you're going to include assets that maybe aren't rightfully part of the company or are overvalued. Or you might be excluding liabilities. Or, as we often see, people are wanting to drive valuations as low as possible. So you might be increasing liabilities, increasing the dollar amount and so forth to try to drive the business's value lower. So understanding if the assets and liabilities are being reported appropriately. Relying on flawed financial data. So we talked about, is it reliable? Again, there are ways to manipulate data, and that's something that you want to keep in mind when you're analyzing the results of the valuation. Well, what is the underlying cash flows and financial information they were utilizing to determine that valuation? And then reliance on you could have perfect, accurate data, but if you're not using the appropriate valuation model, you would also get to an inaccurate valuation conclusion. So that could be, as Shawn mentioned, the different standards of value. If you're relying on the wrong standard of value, that will get you potentially a dramatic or a different valuation conclusion. Underlying flawed assumptions, those could be about potential growth or contraction of the business into the future. Relying on too high or low profit margins, using the wrong valuation multiples. The market data that you're relying on is not comparable to the subject company. There's a lot of available data out there, but it's not always comparable to the underlying company. Someone may try to make it comparable because it helps to get them to the conclusion that's desired. But it could be a size issue, it could be a location issue, it could be the specifics of the company's operations and where it is within the supply chain or what have you, their underlying supplier relationships, some of their built-in advantages or disadvantages within the marketplace, either on a micro or macro level. So there's a lot of different things that could be improperly input or used in a valuation model and the model itself that can get you an inaccurate conclusion. And that, of course, includes which can be often the most impactful, and that's the valuation discounts. The discounts, some of the aspects of the discounts that are utilized are objective, but there's often a subjective component to the discount rate. Shawn, do you want to add anything about red
Yeah,
flags in
the
business
other
valuation?
funny example I always give is like with tax returns. Like people don't realize that tax returns follow the Internal Revenue Service instead of generally accepted accounting principles (GAAP), which are used for financial statement purposes. And so, like a company could buy a bunch of equipment in December if they had a really good year, and for tax purposes, you'll get a deduction for all that equipment because you get you recognize that when you do the acquisition if you do the cash basis, whereas for financial reporting, like a big company would expense that over the asset life, 5 to 7 years, for example, and a lot of like equipment. And so like those kinds of things is like, the tax returns are being done in connection with the IRS world, which is way different than, they're sometimes even have to have normalization adjustments to it.